guys, welcome to Learn Extra Live Accounting. Finally, we're on accounting. They love accounting. Hi, Mahesh, how are you?
Hi, Katleko. I'm well. I'm a bit tired. It's
Really?
almost end of term.
Yes, and it's almost
Can you
end of the
believe
week
it?
as well. I can't believe
End
holidays
of
are coming
first
up.
term.
I cannot believe it. I don't
No.
think they've done enough work to be ending the term, hey?
Yeah, I think we teachers feel like that
I
as
know.
well.
I know. So today, what are we doing in accounting?
Well, today, Katleko, we're going to be focusing on company financial statements. Remember last year, guys, or sorry, not last year, but last week, Martin focused on company ledger accounts. So today, I'm going to look at financial statements.
Okay, thank you, Mahesh. You can go over to your board.
Okay.
So guys, you heard what we're doing today. It's going to be absolutely fantastic. I hope that you guys have already ran to the page. If you don't know what it is, that's facebook.com/learn extra, guys. It's going to be such a great show, and I need you guys to ask as many questions as you possibly can, grade 12, because this accounting stuff is really, really awesome, and I know that you guys want those extra marks just to push you ahead of the rest. So make sure that you're on our Facebook page. Our Twitter handle is @LearnExtra. You can ask as many questions as you can on both platforms. And of course, learnextralive.co.za/live. That is where you can get your notes, schedules, videos. Of course, youtube.com/mindsetlearn is where you can watch previous accounting videos and anything else that we do here. So make sure that you are exhausting all of these platforms, guys. They are out there for you. They're out there to help you. Please make sure that you are with me all the way on the page. Tell me if you've joined us, grade 12. I know you're excited to be here, and so am I. Over to you, Mahesh.
Okay, thanks, Katleko. Hi, guys, again. Like I mentioned, we're focusing today on company financial statements. Okay, in this lesson, grade 12s, we're going to be looking at, let's just get a pen out there. We're going to examine the changes made to the format of an income statement and a balance sheet of a company. Now remember last year, guys, you obviously did financials for a partnership. In grade 12s, we're looking at form of ownership being your company. Then we're also going to recap on certain GAAP principles. And then finally, guys, we're going to try and focus on some year-end adjustments when we're doing an actual example. Right, so let's start. Let's start firstly with some definition, guys. Income statement. Now remember, if I had to ask you what is an income statement, immediately we as accountants, we think of two words. I'm either making a profit or I'm making a loss. So the definition of an income statement, guys, the income statement will show the trading result. In other words, has the business made a net profit or a loss for a specific accounting period, which we all know is usually 1 year. All right, let's go down a bit. Included, or in our income statement, what do we include? We've got to take into account all income as well as all expenses for a specific period of time, again, 1 year. Right, guys, if I want to calculate a profit or a loss, I've obviously got to add all my income, subtract my expenses, and I'm able to work out whether I've made a profit or a loss. And in accounting, this is done by completing that income statement. Now, let's look at your format of your income statement. Okay. The format, guys, is very much the same to your grade 10 accounting and your grade 11 accounting. What do I mean by the same, almost the same? We're obviously going to start off with sales because that's our main, that's our primary source of income. Sales, we're still going to subtract debtors' allowance. Then you're going to have your cost of sales, you're going to work out your gross profit, add other operating income like your rent income, commission income. You could have had a profit on sale of asset. Okay, we're still going to subtract all our operating expenses. And please remember, guys, when you're doing this, operating expenses obviously is in brackets. Then, moving down, we're then going to be looking at, let's just extend the page there a bit. There we go. We're going to work out still our operating profit. To that, we add interest income. We're still going to subtract interest expense, and now we come to the changes that we're going to find in grade 12 when doing financials or an income statement for a company. Instead of ending with net profit for the year, guys, we're now going to have a line for, sure, that line is quite skew. Oh, there we go. We're going to, yeah, let's just fix that quickly, guys. This doesn't look nice at all. There we go. Okay, so the changes, profit before tax. Let's get this line a bit more straight. There we go. Profit before tax, guys, which means we've got to take into account income tax. Now, last week, Martin spoke about taxation, and remember he mentioned income tax, or at the end of the year, you get your tax assessment. So that is what we have to take into account. In other words, the receiver, you've made a profit. This is the tax that you're going to have to pay us. So after subtracting our income tax for the year, we then have our net profit for the year, which we're going to transfer to note number 9, which I am going to discuss, note number 9 being our retained income note. Right, that was your income statement format. Let's now go to your balance sheet. Okay, let's just move. Right, there we go. Balance sheet, guys, your definition. Firstly, what is a balance sheet? It is obviously a statement of the financial position of the business on a specified date. And we accountants know that the balance sheet, simply put, is assets, A, is equal to equity, owner's equity, plus liabilities. That is your balance sheet in a nutshell. Let's look at the format of your balance sheet very quickly, guys, because you are familiar with this, and obviously we're noting the changes to the balance sheet itself. Right, the first part of your balance sheet is A, in other words, my assets. Now, we know from grade 10 accounting, assets is made up of non-current assets as well as current assets. So in my balance sheet, I'm going to list my non-current assets, then I'm going to list my current assets, and I'm then able to calculate or show my shareholders what is my total assets for the business. Okay, so we've looked at A. Let's now look at owner's equity, equity of the business. And this is where the changes happen, guys. Changes from grade 10, your sole trader, grade 11, your partnership, to grade 12, where we're dealing with companies. Okay, so looking at equity, equity or your ordinary shareholders' equity is made up of 3 very, very important items. Your ordinary share capital being 1, followed by share premium, and then we've got retained income. Okay, guys, so these 3 items added up would give me my ordinary shareholders' equity. Right, so we've looked at owner's equity. What's left in your balance sheet? We've done A, we've looked at O, now let's look at, correct, guys, L, liabilities. So under liabilities, remember, you obviously have your non-current liabilities. Let's just make that bigger. Okay, your non-current liabilities, and then we obviously have our current liabilities. So in the actual balance sheet itself, guys, obviously liabilities looks very, very similar to your grade 10 balance sheet, your grade 11 partnership balance sheet. There's no changes to liabilities itself. The change is here. Okay, it's here, your equity, ordinary shareholders' equity, because we're now dealing with companies. Right, let's move on, guys. Okay, I want to look at certain key notes. I'm not going to look at all the notes, grade 12s, but just the key notes and show you where some of the changes are going to take place in terms of companies itself. So let's start with your note, trade, and other receivables. And if we look at this note, guys, whatever I've obviously highlighted in blue, that is where the changes are going to take place. So let's go immediately to the change itself. You're going to notice that sometimes SARS income tax, if you've got a debit balance, it is obviously shown in your note, trade, and other receivables. Now, what do I mean by the debit balance SARS income tax? Let's assume for the financial year, you've made payments to the receiver totaling, let's take an amount of 50,000. So you've made provisional payments to the receiver for this financial year, a total amount of 50,000. You then get your tax assessment at the end of the year, and your tax assessment comes back as 48,000. So in other words, you should pay the receiver 48,000, but you've paid the receiver 50,000. Now, in that situation, guys, I can almost hear you calling out the answer. In that situation, the receiver of revenue is owing you 2,000. In other words, you've overpaid, and because you've overpaid, SARS now has a debit balance. It is an asset to the business, and the receiver will be owing you 2,000 Rand. Okay, all right, let's move on to the next note. Ordinary share capital. If we look at this note, completely new, obviously to grade 12s, to companies itself, this note is made up of the following two categories. We have authorized share capital, which we're going to disclose, and then the next category, which is your issued share capital. Just fix that. Okay, we've got, oh, this pen doesn't like me, Kadleko. Okay.
Not today, hey?
Not today. That's because I know what I'm doing wrong. I'm using the pen and I'm using my finger at the same time.
Oh.
Okay. Right. So, guys, we've got our issued share capital. I'm not going to explain these notes in detail, guys, because it's probably going to take us more than an hour. I want to move on so that we can get to an exam type question. But let's just note the changes as far as companies' financial statements are concerned. Okay, the next note, completely new again, is share premium note, again made up obviously of equity or forms part of shareholders' equity. And then, very, very important, guys, retained income. Okay, this note, obviously new, it is a new note, but if you look at this note itself, absolutely important, very, very I can't stress on how important it is for you guys to know this note for the exams, whether it's your June exams or prelims or your finals. This note, an absolute must. You must know this note. Let's go through this note very quickly. You're going to start off with retained income at the beginning of the year. To that retained income, you are then going to add your net profit after tax. And remember, net profit after tax, guys, is going to come from your income statement. Okay, then we've got our ordinary share dividends, which needs to be subtracted. And ordinary share dividends is made up of paid as well as recommended. Right, guys, we're almost done with the format. Let's now look at the very final note where you're going to encounter certain changes, trade and other payables. Now, in this note, or when doing this note, what changes are you going to find when doing financials for a company? The first change is SARS income tax. Right, now you're probably thinking, but hang on, we've already come across SARS income tax. SARS income tax, if it ends up with a credit balance. What do we mean by credit balance, guys? I spoke about a debit balance earlier. Let's now look at a credit balance. In other words, let's look at a different scenario using the example that I previously used. So let's assume you paid the receiver for the year 50,000, but then you get your tax assessment at the end of the year and they tell you, SARS tells you, you are owing us 52,000. Okay, so immediately, guys, can you see we still have to pay the receiver 2,000 Rand. In other words, we are owing the receiver 2,000, hence it's obviously a liability, so that 2,000 is disclosed in my trade and other payable note. Okay, guys, you got that. I'm going to say that one more time. If SARS is a debit balance, it means the receiver is owing you money. It goes into trade and other receivables. If SARS is a credit balance, you are owing the receiver money. It's going to go into trade and other payables. Okay, I hope you got that. Right, and then finally, guys, the very last change in trade and other payable note that we're going to come across will be shareholders for dividends. Shareholders for dividends, this normally is made up of your final dividend. Final dividend that you've declared to your shareholders, you haven't as yet paid your shareholders the final dividend, and hence it's a liability, current liability falling under trade and other payables. Okay, how are we doing, Katleko? Any questions on the format so far?
Not yet.
Not yet.
Not yet.
Okay.
But we can take a break
Yeah.
if you're at the end.
Okay, that's fine. Let's do that.
Okay, so guys, we're going to take a very, very short break. During this break, please consolidate everything that you have so that you can start asking questions, guys. We're ready for your questions. We want to know that you guys fully understand. Okay, so do that during the break. See you just now. Welcome back, Mindsetters. If you have just joined us, we are doing grade 12 accounting. It's been awesome so far, and I hope that you guys have all your attention on us and on the page, guys. Those are the only two things that you should be concentrating on right now. Tell everyone to leave the room so that you can do some accounting. I want to tell you guys about what the month of May signifies for us here. The month of May is Library Month, guys. I need you guys to tell me or to let me know what you think this is. I'll tell you a bit about it. But make sure that you are actually on the page and you are chatting about Library Month, guys. It's the month of March and it's Library Month. What are you guys reading? We are ready to do some awesome giveaways, some awesome quizzes, some awesome everything, guys. You know how we do. We really go all out about books, about what libraries contain and what the awesome things about them are. Shoot over to the page. Tell me what your last book was, the last book that you read, or your favorite book even, because I'm ready to hear about that. Over to you, Mahesh.
Okay, thanks, Katleko. Right, guys, I'm ready now to move on, and let's look at some of the GAAP principles that we take into account when preparing financials. Right, now, very important, guys. I'm focusing on certain GAAP principles, and I'm obviously looking at the most important ones. Right, let's start off with matching. Okay, now what do we mean by matching, guys? Come, you know this one. Okay, I'm sure you do. All income and expenses must be matched to the same period in which they incur, regardless of whether the income has been received or not, or the expense has been paid or not paid. In other words, whether you've paid or it's still outstanding, it's still accrued, it needs to be matched to the correct accounting period. Now, very quickly, guys, what do we mean by this? Okay, let's draw a timeline, and let's assume our financial year started on the 1st of March 2012, and it ended on the 28th of Feb 2013. What this GAAP principle is basically telling us is all income and all expenses that are shown in the financial statement, in your income statement, must belong to this timeline. In other words, whether it has been received, physically received, or it's still outstanding in the case of income, as long as it has incurred or it belongs to this timeline, it must be included in my income statement. If there's anything that is outside this timeline, GAAP matching principle is telling me, take it out from there, it doesn't belong there, exclude that amount. Okay. Right, let's move on to the next principle, guys. We're looking at another GAAP principle, and this time it is prudence. Now, when we talk about prudence, again, what do we mean? Prudence relates to, or prudence simply means, financial results are reported in a very conservative manner. Okay, now, conservative manner in accounting simply means don't overstate your amounts. Rather understate it than overstate. So a very simple example, guys, your trade creditors. Let's assume your trade creditors is 10,000 Rand, but from past experience, you know that 1,000 Rand would not be received. In other words, 1,000 Rand could be potential bad debts. So if you look at this 1,000 Rand, you are now telling your shareholders, in my balance sheet, when I make an entry, or when I disclose is the correct word, when I disclose my debtors, I will disclose my debtors at 9,000. I'm being conservative. I am understating rather than overstating. Okay, and then finally, guys, the last GAAP principle which I want to touch on is your historical cost concept. The general rule is that assets are valued at their historical cost, and here we're talking mainly about land and buildings, guys, and trading stock. Will be showed in the balance sheet at their original cost. In other words, what they were purchased at, that's what we mean by their cost price. There are, however, certain exceptions, especially in the case of trading stock, which sometimes over a period of time, depending on the type of stock the business is selling, there could be a devaluation of that stock itself. Okay, right, Katleko, we're now coming to an actual question.
Okay.
Okay, so let me
And
just
if the
quickly
learners
find
have
that.
questions as well, you guys need to shoot them over, guys. We just do questions so that you guys get to understand the concepts and you get to see how they are applied. But you guys need to send us questions asking us, you know, just say, Mahesh, I don't really get what you just said. What did you mean? Or, you know what I mean? Like, just shoot over questions that we know that we can help you with, just to clarify those little things, guys.
Okay,
Over to
so
you.
we're ready to start
We're
with a
ready to
question,
start this
an
question.
exam type question.
Sure.
Okay, let's start, guys. Let's read through the question, because remember, in accounting, it is so important that you read through the entire question first, and then you obviously start with your answers. Right, in this question, you are provided with an extract of the pre-adjustment trial balance, obviously before adjustments, adjustments and additional information of RK Limited on the 29th of February 2008. The business buys and sells office equipment. Stock is sold at a markup of 60% on cost. And let's just put this markup into a little block, because we might need that information. Your instructions. You are required to prepare the following notes to the balance sheet. So we have to prepare inventory, retained income, and then trade and other payables. And then, guys, the big one, prepare the income statement for the year ended 29th of February 2008. So immediately, guys, it's obviously an income statement. Because it's an income statement, very quickly, I want to draw a timeline for the financial year that I'm working for. Financial year ended 29th of Feb 2008, which means this financial year would have started on the 1st of March 2007. Okay, right, let's move on. We're now looking at our information, and immediately we notice there's that pre-adjustment trial balance, and this is obviously my starting point. Now remember guys, I'm doing 3 notes and an income statement. And what do I mean by pre-adjustment trial balance is my starting point? Starting point in the sense that I'm now going to take the relevant information from this pre-adjustment trial balance and slot it into my notes and into my income statement. Okay, so very quickly, let's look at the information. Obviously, guys, it's the highlighted information just to make it easy for us. Starting with sales, okay, all the way down to my interest on loan. This represents my nominal account section, so immediately these totals need to be slotted into my income statement. And then if I go up further, there I have retained income. Remember, I've got to do the retained income note. So this retained income is my 1st of March or beginning of the year balance. And then further down, I've also got to do trade and other payables. So I've got creditors control, guys, pension fund, SARS, PAYE, which we're obviously going to get to, but for now, okay, those 2 items. And then I've got to also do the inventory, which means I need my trading stock balance thus far. Right, now what I've done, if we go to our answer sheet, let's quickly find the answer sheet, guys. Okay, so trading stock. Let's go to our income statement, guys. Okay, there we go. So what I've already done so that we can work with those adjustments, I've already brought down my amounts in brackets. So let's look at sales, 797,500, and I've already subtracted debtors allowance. Okay, so let's quickly go to the question so that no one is lost as to what I've just done. So there's my sales amount. Okay, guys, there's my sales. And then below that, there's my debtors allowance. I've already taken it through to the income statement in brackets, because remember, bracket work is absolutely important. And I've obviously done this for the rest of my income statement, so I've got some kind of skeleton to work with when I'm actually doing the actual adjustments. Okay. So we're now ready to go to the actual adjustments, guys, because I've brought down everything that I needed to in brackets. So let's go straight to our adjustments. Let's tackle each adjustment. Adjustment number 1, rent has been received for 11 months only. Okay, now what I want to do is, let me quickly, again, put our timeline, 1st March, and we know it's 2007, 28th Feb 2008. So this adjustment tells me rent has been received for 11 months only, which means for the month of Feb, the tenant has obviously not paid his rent. We haven't received the rent. And the GAAP matching principle tells me anything that belongs to this timeline needs to be included. It needs to be added on. So let's now do our calculation and let's adjust our rent income. Okay, so to our answer sheet, let's go to our rent income. At the moment, guys, our rent income is 22,000. So we're now going to take our 22,000. Let's get a pen out. So we've got 22,000. This is only for 11 months. I'm going to divide by 11, which means my monthly rent is 2,000. And I'm now going to add, or I'm going to include this 2,000 in my income statement. So let's go back to our income statement, our answer sheet, guys. And we're now going to get a pen there. We are going to add 2,000. Okay. Remember, guys, that 2,000 is accrued income. I am not doing trade and other receivables, so I don't have to worry about recording this accrued income. Okay, done with the first adjustment. Let's now move on to our next adjustment. Okay, so further down. Right, this adjustment reads as follows. Included in insurance, so we're now moving on to an expense. Included in insurance is an amount of 2,400 Rand paid for the period 1st Jan 2008 to the 30th of June 2008. Okay, so another adjustment testing the matching principle. Okay, right, guys, again, keep on drawing, or I'm obviously repeating this timeline, but there's a reason for that. So 1st March 2007, 28th Feb 2008, and let's now look at this actual adjustment. So I just want to change the color of my pen quickly. So we've got insurance that was paid for, fix that. Okay, so we've got insurance that was paid somewhere here. So 1st Jan and all the way up until the 30th of June. So immediately, what have we noticed? We've noticed we've gone outside our timeline. And GAAP tells us anything after this timeline or after the 28th of Feb 2008 must now be excluded. It must be removed. It must be subtracted. So let's do our calculation. Let's work out what the actual adjustment is. So if we take our 2,400, which is the amount of insurance we've paid, and if we divide this for 2,400 from the 1st of Jan, guys, to the end of June is 6 months. Okay, we're going to find that we've obviously paid for each month 400 Rand. And what do we want to exclude? We want to exclude the months after the 28th of Feb. In other words, the months of March, April, May, and June, including June. So we've got March, April, May, and June. So 400 times 4, we have to remove from insurance 1,600. Okay, let's now go to our income statement and let's do exactly that. So in our income statement, we're obviously looking for insurance. So let's just quickly scroll down. Insurance, there we go. So we're now going to subtract 1,600. Okay, absolutely simple, guys. Easy. It's obviously not difficult. How are we doing there, Katleko?
We're doing good. Are you ready for a break?
I think we can.
I think we can do a break. I know that you guys want that little bit of a stretch and a glass of water, but please don't go far, guys. We are ready and steady for any one of your questions, guys. I'm here on the page and I'm looking at those who are on and those who are not on. Well, I can't see you, but I'd love you to join us right about now. See you right after the break. Welcome back, Mindsetters. Welcome back from that break, guys. I hope that you guys have put your questions up. I've answered some on the page, and Mahesh has gone through some. I hope that you guys are listening closely, because some of the questions that she asks, she answers in what she's saying. So that's why you should listen out, guys. It's really important that you listen and extract everything that you need. Remember that the notes that she's working on now are on our site, guys. That's learnextra.co.za/live, and I've posted the fast link on our Facebook page. Click on it and see where it'll lead you, guys. There's some really fantastic stuff out there. I hope that you guys can actually access it and share it with others as well. Over to you, Mahesh.
Okay, before we carry on, Katleko, we had that question about share premium.
Yes.
You want to just read it out so that I can...
Sure. Mulebuheng asks, no, actually, sorry, it's Songezo. Songezo asks, I'd like to know why the share premium isn't added to the income statement. Please help me with that.
Okay, right. Now, the reason for that, guys, is if you look at share premium, it's neither an income nor is it an expense. What is share premium? Share premium is equity owner's equity. It's a balance sheet item. So because it's not an income, it's not an expense, it does not belong in that income statement.
Okay, that's answered. Thank you.
Okay, brilliant. Right, can we move on?
Yes, we can.
Okay. Let's look at the next adjustment, guys. Packing material, that's what we're looking at now. Adjustment number 3, packing material used, very important. Packing material used during the current financial year amounted to 4,000 Rand. Now, before I look at the actual adjustment, guys, this is a mistake that we find often when we mark your final exams, is a lot of students confuse the word used and stock that was unused. Now, what do we mean by this? What do we mean by students get confused? Let's take the following example, since we're dealing with packing material. Let's assume for the financial year, you've purchased packing material amounting to 10,000 Rand. And you now get an adjustment that tells you at the end of the year, you've used 4,000 Rand of packing material, which means I have used up, obviously, okay, so let's just extend that. I've used 4,000. How much was not used? Unused packing material, in this case, would be my 6,000. Now, what is an expense? An expense is something that is used. In other words, obviously it can't be reused. You've now used the item. It's considered to be an expense. So that 4,000, the packing material that we have used, is your expense. Whatever you have not used cannot be classified as an expense, guys. In this case, this 6,000 is what we determine or what we classify as being an asset. I'm going to say that one more time. When you deal with an adjustment like packing materials or stationery, and the question tells you that you have used or you have not used certain amounts of either stationery or packing material, whatever we have used is an expense and belongs in that income statement. Whatever is not used is an asset and therefore belongs in your balance sheet. Right, so let's now look at this adjustment specifically, and let's see what we're going to show in our income statement and what we're going to take to the balance sheet note. So I quickly want to get rid of what I've just put up here. Okay, let's get rid of that quickly, guys. Okay, right, so 4,000 is not used. Let's now go to our actual income statement. So there we go. I'm looking for packing materials, and there we go. So packing materials in total, guys, get our pen out. We've purchased 5,600, but we've used 4,000. So immediately, guys, I'm going to take the 4,000 and I'm going to show this as my expense. Whatever I have not used, what have I not used, guys, would be 5,600 minus the 4,000. So I have not used 1,600. Am I right? Yeah, that looks correct. So I haven't used 1,600, and therefore it doesn't belong in that income statement. I'm now going to send it to my balance sheet note. Which particular note am I talking about? Absolutely correct, your inventory note. So let's find your inventory note, guys. Okay, so there's my inventory. Just extend the page here. And remember, this has a very special name: consumable stores on hand. And unused packing material is 1,600. Okay, hope you guys got that. Katleko, do we have any questions?
Someone just asked you actually I know that it's not related to this, but they're asking, or maybe it is a little bit, is there a difference in retained earnings and retained income?
No.
And that's from Karabo.
No, there isn't a difference.
Okay.
I know there's one particular textbook that calls it retained earnings.
Okay.
Other textbooks refer to it as retained income. They often also call it accumulated profits.
Okay.
So it all means the same thing. So
Okay,
for
there you
example,
go.
Katleko is cats,
Yeah.
is K, it means the same
Yeah.
person that we're talking about.
Okay, thank
Okay,
you.
is that it?
Yes.
Okay, brilliant. All right, let's look at the next adjustment.
Wait, Mahesh, before you carry on, can I actually just ask you another question here? Let me just find it, sorry. Wumpy, that's an odd name. Can she please repeat the insurance adjustment? I mean, guys, it's fine. I will try post this for you guys. I know that Wimpy, I know that you asked a question, and also other people have been asking questions. I get you guys. I get you. Mahesh will answer these questions. I've said that you must answer questions, and I love that you guys are posting questions. So, Mahesh, could you perhaps maybe carry on a little bit, and then later on we'll try answer a bit more questions.
Okay, I think let me go back to it.
Okay.
Because there's not much time.
Oh,
So
okay.
let's take the questions and then we'll obviously see if we can get to the other adjustments. So which question was it again?
About
It
the
was
insurance
the
adjustments.
insurance, which was adjustment number 2.
Yes.
Okay. Right, adjustment number 2, guys, the insurance adjustment itself. If you go back, or let's just go back to this adjustment, you've got included in insurance is an amount of 2,400 Rand paid for the period 1st Jan 2008 to the 30th of June 2008. Now, if I look at this and I use my timeline, immediately I notice, so I've started my payment on the 1st of Jan, which is fine, it's in the financial year, but it goes all the way up until the 30th of June. So immediately there's a problem. It's outside my financial year, outside that timeline. So the matching principle tells me whatever belongs to this timeline include, which is fine. So from the 1st of Jan to the end of February, 2 months is absolutely fine. It belongs there. But anything after the 28th of February now needs to be removed. In other words, this is obviously a prepaid expense. It belongs to the next financial year. So if we look at our actual calculations, we've paid a total of 2,400 and we've paid this for 6 months. Where am I getting the 6 months from, guys? 1st of Jan until the end of June. Even if you have to use your fingers, use your fingers. So Jan, Feb, March, April, May, June, which gives me the 6 months. 2,400 divided by 6 means I've been paying insurance of 400 Rand per month, and I now need to remove 4 months of insurance. 4 months being the month of March, April, May, and June. So my adjustment would be 400 times 4 to give me the 1,600. And that is what I then take to my income statement. Let's just go back there quickly. Okay, so your insurance, we're now removing, we are subtracting 1,600 because that amount does not belong in this financial year. Remember, all expenses, all income must be matched to the correct financial year. Okay.
Okay, thank you.
Right, any more questions?
No more for now. I think
No
you
more
can
for
carry
now.
on. with
Okay,
yours,
brilliant.
yes.
Right, let's go back to the next adjustment, guys. Right, your next adjustment, we've got adjustment number 4. No entry has been made for stock returned by a debtor. So we've got stock returned by a debtor on the 25th of Feb 2008. Immediately, 25th of Feb 2008 belongs to this financial year. Selling price 1,400. Right, guys, this is a very common adjustment, and let's go through this adjustment. Now, remember, when a debtor returns stock, you obviously need to cancel the sale. Cancel means, what do I mean by cancel? We need to remove this from our records because this sale, he's now returned stock. The sale is now cancelled. And if we cancel sales, we've got to also cancel cost of sales. So let's now look at selling price, and then we're going to look at cost price. The selling price is given to us. They clearly tell us selling price is 1,400, And which two accounts are going to be affected by this 1,400? It's going to be your debtors allowance. So debtors allowance is one account, and the other account will be debtors control. Now let's start with debtors allowance, because debtors allowance obviously affects my income statement. So let's go to your income statement. Okay, in my income statement, debtors allowance, guys, remember, has already been subtracted from sales, but I'm now telling myself, or I'm now telling my shareholders rather, I've got a further 1,400 that now needs to be removed from sales. So let's do that. We're now going to subtract, let's fix that. Okay, so we're now going to subtract 1,400 from sales. Okay. Right, back to our question or our adjustment. So we've now obviously recorded the impact that this transaction had on our income statement for sales. Let's now look at the contra account. Contra means the other account affected. The other account is your debtors control. Now you're probably thinking, but hang on, I'm doing an income statement. I'm doing trade and other payables, retained income. Why do I have to worry about debtors control? Because I'm not doing trade and other receivables. The reason for that, guys, the reason why I've got to still take this adjustment into account is somewhere in the question, I may have to adjust provision for bad debts. Okay, so you now know what I'm talking about. So let's now go to your debtors control, and we're obviously going to do this on the question itself, just as a reminder. So let's find our trial balance. There we go. So I'm looking for debtors control, and I'm now reminding myself that when I do get to that provision for bad debts adjustment, I need to remember to subtract 1,400 from debtors before I do the provision for bad debts adjustment. Okay, right, let's go back to that adjustment because we haven't finished. So we've now, just bring that down a bit there. Okay, so we've now dealt with selling price. We now need to look at cancelling or taking into account our cost price. Now, our cost price, obviously not given to us, but right at the beginning of the exercise, do you guys remember we had a markup? A markup was given to us. Okay, let's go back very quickly to the beginning of the exercise, guys. There we go. A markup of 60% on cost is given to us, which means we can obviously, let's just try to get there quickly, we can calculate our cost price. So in order for me to calculate my cost price, I'm going to take my selling price, 1,400, I'm going to times this by 100, divided by 100 plus markup, which is 160. Let's get that calculator out quickly, guys. Okay, there we go. So we've got 1,400. Okay, I'm timesing it by 100, dividing it by 160, and my cost price that I've got to cancel, 875. So let's put that down. So 875. What do I mean by cancel? If I've cancelled sales, let's now go to that income statement. We've got to cancel our cost of sales. I'm going to subtract 875. Katleko, I think that's about it as far as we can do, or in terms of time.
So did you finish off what you needed to say?
I finished off this adjustment itself.
Okay.
Are there any questions?
Yes, there actually is one that we can do really quickly.
Okay.
Someone asks, let me check who it is. Nicola. Nicola asks, do we include pension deductions in the income statement, and is stationery also a part of inventory? And how do we write off depreciation?
Okay, right,
very
question. Quickly it is. Let's look at the first one. The first one was pension
include pension deductions in income statement.
Pension deductions, yes, Nicola. Unfortunately, we ran out of time, but I was going to come to that adjustment. Pension deductions, in other words, pension contributions made by the business is an expense item, so that will go into your income statement. The pension fund, however, goes into your trade and other payable note because that is the liability.
Awesome.
Okay.
And the next part of the question is stationery also part of inventory?
Okay, stationery on hand, in other words, unused stationery, that would be part of inventory. But the stationery that is used is your expense, but whatever I have not used is my asset, so it is part of inventory.
Thank you, Mahesh.
Okay.
So guys, your questions have been answered. Our show has sadly come to an end. I know most of you are thinking, oh, can't we have an extra hour? But unfortunately not, guys. We have business studies coming up next. So please, guys, please stay with us. Don't move off those seats. And we are in for a treat, guys. Of course, you guys need to keep answering each other's questions. Keep helping each other. The page is always available for you guys. It's open and it's ready for you. Please use it to the fullest of your ability. Guys, from us here, bye-bye, and I hope you have a fantastic evening.